Markets don't collapse when problems appear. They collapse when everyone realizes the problems were already there. The danger isn't what moves prices, it's what doesn't. When everything feels stable, when volatility drops, when fear seems irrational, that's not safety. That's the moment just before the recognition hits, and by then, it's already too late to react without cost. Most people believe markets work like alarm systems. They think risk shows up as volatility, that red candles mean danger and green ones mean safety, that if something were truly wrong, prices would reflect it. This makes intuitive sense. We're told markets are efficient, that they process information instantly, that thousands of participants collectively price in reality. So when markets are calm, when the VIX is low, when bonds and stocks both drift upward without drama, the natural conclusion is simple: nothing is wrong. Calm becomes evidence of health, stability becomes proof of safety, and that belief becomes the foundation for every decision that follows. But markets don't price reality, they price consensus about reality. And consensus forms slowly, reluctantly, only after enough participants are forced to acknowledge what they've been avoiding. Markets are designed to handle known risks, the risks everyone sees and debates and hedges against. Those get priced in continuously. What markets cannot price efficiently are the risks no one wants to acknowledge exist, not because the information isn't available, but because acknowledging it would require action, and action would disrupt the calm everyone depends on. So the information sits there, visible but ignored, while prices continue to reflect not what is, but what participants need to believe. The system rewards calm, not because calm reflects reality, but because calm allows the system to continue functioning. Fund managers are measured quarterly. Calm quarters mean stable performance, new redemptions, new difficult conversations. Analysts who warn of risks during calm periods don't get credit. When those risks eventually materialize, they get remembered for being wrong during all the months when nothing happened. Central banks face pressure to avoid disrupting markets because market disruptions create immediate political costs, while systemic risks remain abstract until they aren't. Corporate executives are incentivized to guide toward consensus estimates because beating expectations by staying aligned with the narrative is safer than warning the narrative might be wrong. Everyone inside the system has a reason to prefer calm, and when everyone prefers calm, calm is what you get regardless of underlying conditions. This isn't conspiracy, it's incentive. The structure rewards delay, and delay produces the appearance of stability. That appearance then becomes the justification for continuing the same behavior. While prices stay stable, other things don't. Leverage accumulates quietly. Positions grow larger because volatility is low, and low volatility makes larger positions feel safe. Correlations tighten as similar strategies crowd into similar trades, all assuming liquidity will be there when needed. Balance sheets stretch because credit is cheap, and cheap credit makes extending easier than contracting. None of this shows up in price charts. Price charts show calm. Calm prices encourage more of the behavior, creating the hidden stress. And the gap between what prices show and what balance sheets carry grows wider. This is what calm hides. Not that nothing is happening, but that what's happening doesn't register as risk until the structure can no longer support it. The pressure builds in places markets don't measure: collateral chains, margin requirements, rollover assumptions, liquidity expectations. These don't move prices until they break, and they don't break until something forces recognition. History doesn't repeat, but the pattern of calm before breaks does. In 2007, markets were calm through the summer, while subprime mortgage defaults were already accelerating. The information was public. The risk was visible. Prices didn't move because no one was forced to act on it yet. When Lehman failed in September 2008, it wasn't new information that moved markets. It was the collapse of the assumption that someone would prevent it from mattering. In early 2020, COVID was spreading globally for weeks, while US markets made new highs. The risk was known. The outbreak was documented. Markets stayed calm because participants assumed either containment or minimal economic impact. When that assumption broke, the entire move happened in less than a month. The outcomes in each case were different. The structures were different. The triggers were different. But the calm beforehand was identical, not because participants didn't have information, but because having information and acting on information are not the same thing. The break always feels sudden because repricing happens all at once. Risk that was ignored for months gets priced in over days. Positions built over years get unwound in hours. This isn't because new information appears suddenly, it's because the threshold for ignoring existing information finally gets crossed. Once it crosses, everyone moves together. Not because they all suddenly see the same thing, but because they all see everyone else moving. And in that moment, calm doesn't fade gradually, it disappears completely. The market that seemed stable yesterday becomes illiquid today. The trades that worked for months stop working overnight. The assumptions that felt reasonable become obviously wrong in hindsight. But they were wrong before. The only thing that changed was recognition. People trust calm too much because they trust markets to tell them when to worry. This makes sense in theory. Markets aggregate information from millions of participants, many of them professionals with resources and expertise. If they're not worried, why should you be? But this logic only works if markets are reacting to information, not delaying reaction to it. And during periods of structural stress, markets delay because the participants inside them are following incentives that reward delay. During calm, certain things don't get said. Analysts don't downgrade when prices are rising because downgrades during rallies make you look wrong. Risk managers don't escalate concerns when volatility is low because escalating during calm makes you look alarmist. Policymakers don't tighten aggressively when markets are stable because tightening into stability risks breaking what appears to be working. Everyone stays quiet, not because there's nothing to say, but because saying it accomplishes nothing except professional cost. And that silence gets mistaken for agreement. If no one is warning, it must mean there's nothing to warn about. If no one is hedging, it must mean there's nothing to hedge against. The absence of alarm becomes evidence of safety. But the absence of alarm just means alarm isn't rewarded yet. It will be later, when it's too late to matter. Markets don't warn loudly, they reassure quietly. They stay calm while problems compound, stable while stress accumulates, certain while assumptions go untested. And when the reassurance ends, when calm finally breaks, it doesn't feel like a process. It feels like an event. Sudden, unexpected, inevitable, only in hindsight. But it was always inevitable. The calm was the warning. It just didn't feel like one.